Welcome to our third quarter 2015 strategy review. It's actually amazing to realize we're halfway through 2015. We had our meeting here last Friday, the 26th. Actually, I was away and on a call, and we also had a guest, Andy Leckel of Eagle Harbor Asset Management, who also attended the meeting via conference call. Here in this room, we're on my right, Bob Toomey, Director of Research and Vice President of the firm, and on my left, Len Skina, also a Vice President and CEO of the firm. We certainly had, again, a very long meeting, a lot to discuss, and a lot to look at. But before I pass it off to the other fellows to talk about what we talked about, I'd like to take you on a little bit of a history lesson. I've always ended by referring you to our website to see our previous videos. They are all out there. And today I'd like to specifically refer you to the second quarter 2013, just about 2 years ago, where we talked about a new market high and what that meant for the future. On the screen now you will see the chart similar to the one that we published back in 2013. And what we referred to then, and I'd like to refer to again now, is the secular bull market that appears to be very much in full force. Now keep in mind, a bull market still doesn't go straight up, and there will be reactions, and we'll talk about those as we see them currently. But referring again back to the chart, we saw in 1981 the market break out to a new all-time high after having two significant down periods in 1971 and 1976. That created a bull market which lasted until 2000. Again, not straight up, but the markets went up about tenfold during that period. That certainly can be reviewed and looked at in the past as a very, very strong secular bull market. Where are we now? There's a lot of talk out there that markets are too high. But if we look at a lot of the individual statistics, and again, I'm going to refer you back to that chart, back in 2013, that second quarter, we broke out to a new all-time high after experiencing two significant downtrends at 2000 and 2008. Where are we now? You'll see on the chart. We are up, but nothing compared to what we saw in that period. I personally believe that we have some very strong overlays, and I think that history lesson is something everyone should continue to pay attention to as we go forward. But back to the current, and I'm going to refer to Bob to talk about what's been happening in the current markets and the things that we have to pay attention to. Bob?
Great. Thanks a lot, Stan. So those of you that follow the market closely, we hope you don't do it too closely. Spend a lot of time on that. That's what you hire us to do. But I would like to point out that the U.S. market year to date is roughly flat, as are the European indexes. And the reason for that are several reasons, actually. First of all, there has been continued anxiety about when the Federal Reserve is going to raise interest rates. There has also been a slowdown in earnings growth during the first half of this year due largely to the energy sector, which, as you know, the decline in oil prices impacted the earnings for energy stocks, and that has been reflected somewhat in the market. The third reason has been, more of late, has been the concerns about Greece and the potential for what could happen if Greece defaults, which they appear to have done, and if they leave the euro. So all of those factors together have been keeping a lid on stocks this year. I think the good news is that as we move into the second half, we see an acceleration in corporate earnings growth, which should be positive for equities. And we also see a resolution to the Greek issue in some shape or form. If you look at GDP this year, we had a very slow first quarter. In fact, it was negative in the first quarter. That has also been an impact on the stock market. But of late, we see economic indicators improving. We believe that the underlying economy is stronger than it has portrayed thus far this year, and we do expect the economy to accelerate in the second half and into 2016. That should also be positive for corporate profits. You can see from the chart in front of you that we have had a very strong rebound in corporate profits since the recession of 2009, and we believe that trend will continue, although it won't be at the pace we've seen over the last few years. I would also point out that if you exclude the energy sector from corporate profits, the first quarter was actually up 8.5%, excluding energy. So underlying corporate earnings remain healthy. Inflation, we still continue to believe will remain muted. If you look at core inflation on a year-over-year basis, it's still running under 2%. There's been a lot of talk about wage pressures forcing inflation higher. We believe that U.S. corporations will be able to deal with wage pressures in a way that will not create the kind of situation we had in the 70s. With respect to market valuation, you can see from the chart in front of you that we're currently about 17 times 2015 earnings. That's a little bit above the long-term average of 15, but I would not view the market valuation as excessive. Currently, it's a little bit expensive. A lot of pundits out there in the market are talking about an expensive market, but as Stan mentioned earlier, we do not believe that the market is really overvalued here. We think it's probably reasonable, particularly in light of where interest rates are right now. And we continue to favor equities, largely because they provide growth, and they will continue to provide growth in a rising interest rate environment, and I'll talk a little bit more about that later. I'd like to turn it over now to Len, who's going to talk a little bit about international.
Thank you, Bob. Internationally, we looked at a number of different regions, and while we're still not very excited about things like emerging markets and some of the other areas of the world, we have a fair amount of enthusiasm right now for what's going on in Europe and for the European markets. If you look at this chart, you can see that the European market has not done anywhere near as well recently as the US stock market, and so valuations continue to be quite reasonable there, and we see an opportunity. In fact, the opportunity that we see there, we believe, is one very similar to what occurred in the US about maybe 3 or 4 years ago. And so we think that there's a lot of room for that market to run and recover some of the valuation that's been lost during their most recent depression. With respect to the situation in Greece, it's very obvious if you are watching any financial news anywhere, Greece is the word and everybody's talking about it, but we don't really see it as being a significant issue for the long term. We believe it will be resolved. We believe that it will be resolved in a way that's not going to impact us long term. And we continue, as I said, to be very enthusiastic about Europe for that reason. With that, we actually did increase our holdings internationally, predominantly with that overweighting to Europe. I'd now like to turn it over to Stan to talk about what's going on in the wonderful world of REITs.
REITs, real estate investment trusts, an area that has frankly been very good to us over the years. They are stocks which represent real estate investment trusts. They generally pay a fairly good dividend, and frankly, as I say, most of our clients have enjoyed some very good profits in REITs over the years. We are not necessarily negative on REITs at this quarterly meeting. However, we did note that REITs are starting to follow more the interest rate trends, and since there is a very strong feeling that interest rates are going up, and actually, as will be discussed, interest rates are already going up on many bond issues, we felt it was time to take some profits in the REIT area. So when you look at your statements again, you will see REITs, but they will be a little bit lower, and we decided to take some profits at this time. And now I'd like to turn it over to Len to give us some more information on what we see in the interest rate and bond environment. Len?
Thank you, Stan. Interest rates are going up. The question is when and by how much. But from where we are now, the likelihood is that they have nowhere really to go but up, and all signs point to them moving in that direction at some point. We believe that the Fed would really love to raise interest rates. In fact, we believe that they've wanted to raise interest rates for a little while, but that the world situation just keeps getting in their way. The nonsense in Greece and the things going on elsewhere just kind of keep them from being able to do exactly what they'd like to do, and they're watching inflation closely, and they're just going to make sure that when they raise rates, they're going to do it at a time when it all makes sense. At this point, we're preparing for those rates to go up. We've skewed our bond curve away from the long end because long-term rates tend to be more interest rate sensitive. People are locked in for a long period of time at a low rate and can't get out of it, and so the values of those bonds drop much more than bonds on the shorter or the intermediate term. And so we've, at this point, overweighted things to that short term and the intermediate term. The other change that we've made is that we have taken a portion of our intermediate term bonds and we have put them in something that's a little unusual for us. We've put them in an actively managed ETF. So there is a bond manager that is going to be there deciding exactly how they want to represent the intermediate term bond sector within their ETF. Typically, we're making all of those decisions ourselves, and we're still doing that with a portion of the intermediate term bonds. But for the portion in this particular ETF, this bond manager is going to be able to react more quickly to changes that occur when the Fed finally does act, and they're going to be able to move things in a way that hopefully will better protect you when such interest rate hikes occur. With that, I'd like to turn things over to Bob to talk about the changes that we made in our U.S. equity holdings.
Thanks a lot, Len. Well, you heard me talk a little bit earlier about U.S. stocks. I just want to add to that discussion that we are currently favoring growth over value within our U.S. stock holdings. And the reason for that is primarily because we believe growth stocks can hold up better in a rising rate environment due to the fact that investors perceive stronger or faster cash flow growth as being more valuable in a rising rate environment. We also made some significant changes relative to some of the holdings in our U.S. equities. We added a position in large cap financial stocks, the XLF, which is an ETF that includes both banks, investment banks, as well as insurance companies. You can see from the chart on the screen right now that this sector has underperformed the S&P over the past 5 to 10 years. We believe that the sector offers a value opportunity and good relative valuation, and we think in a rising rate environment, as interest rates rise, it will favor the net interest margin for these companies as financial intermediaries and should help them accelerate their earnings growth. In the developing equity area, we added a position in U.S. home builders. The reason for that is because, as you're probably aware, the U.S. housing stock has been underbuilt significantly since the housing crash of 2006, 2007. There is a lot of pent-up demand for housing. There are actually capacity shortages in a number of large cities in the United States, and we believe that the housing stocks should do well as demand for housing continues and as more homes are built, particularly in the growing areas of the United States on both coasts and areas like Texas and the Sun Belt. So we think that that should add an element of growth to your portfolios. Finally, in the commodities area, we didn't do much in the way of change there. We continue to like our position in the forest products sector, largely because it should benefit from stronger home building and a stronger U.S. economy. We also continue to maintain a position in energy. We believe that energy prices are in the process of bottoming, and we have been seeing recently that, in fact, over a longer period of time, that there could ultimately be some shortages in energy supply. So we continue to like oil, as reflected in the XLE, as a good long-term inflation hedge. And with that, I'll be turning it back over to Stan for some closing comments.
Thanks, Bob. And if you're still listening to me at this point, it means that you've gone through a much longer than normal video. We do try to keep these videos as succinct as possible, but we had a lot to cover this time. So we appreciate you staying tuned in and hope that you got a lot out of our video. Once again, I want to commend you to go out and look at our website, especially back to the second quarter of 2013, to get some perspective on how these meetings have unfolded over this period of time. Till next time, thanks again for tuning in.